Now that we have our full cast of characters on stage, let's commence. Good morning, everyone. Welcome to the first session of day 2 of the 18th Milken Institute Global Conference. And I have been to all 18 conferences. I'm dating myself.
Really?
Yes. So don't laugh too hard. So it's an early morning panel, but I guarantee you there's going to be a lot of energy on this panel. And you're going to see some data that will probably cause you to rethink about what's happening in the retail sector of the U.S. economy. My name is Ross Duvall, as I said. I'm the Chief Research Officer at the Milken Institute. And we're really going to examine, can the U.S. be a catalyst for growth? Question mark. We have a great panel lined up with an immense amount of knowledge and especially depth of expertise and a diversity of opinion. You'll hear some people who may not agree with each other, which I don't think we've heard enough of in the event thus far, so I'm going to encourage that. So we're going to really look at whether the U.S. economy is strong enough to help pull the rest of the world along. Can it resume its traditional role as a catalyst for world growth as Japan is experiencing slow growth? You have Europe, who appears to be growing a bit stronger, but still pretty weak. You have the Eurozone, as I said, benefiting, especially Germany seems to be doing better. Oil exporters, a lot of emerging countries, and the BRICs are not all BRICs any longer. Maybe you have the I and you have the C.
You have the I.
Yeah, you have the I. Maybe not the C. That's our retail expert here. So let's keep in perspective. The U.S. economy over the last 3 quarters of 2014 expanded at an annual rate of 3.8%. That is the strongest 3 quarters of growth in over a decade in the United States. So the question really is, we're going to get GDP tomorrow or later this week, I believe. We'll find out what the first quarter reading was. Most economists have downgraded their estimates to about 1% growth. We'll discuss how much of that might be weather. So the question really is, do you need a meteorologist to understand the economy in the first quarter every year rather than an economist? I would vote for a meteorologist, because you look at the data and it's happened 3 out of the last 4 years. So what I'd like to do is very quickly kind of set the stage of the major areas that we're going to cover. If I could have slide 2, please. It'll show you labor markets. Early in the recovery, job growth was pretty weak, but it has clearly accelerated. Even with the weak reading in March, where we had 126,000 jobs added, the 12-month moving average growth is 260,000 jobs per month. 4 years ago, if you'd have said that was possible, not many people would have believed you. And that's a year-over-year increase of about 2.1% based on the latest data. Also, slide 25, looking somewhat at the consumer sector, consumer spending adjusted for inflation grew at about 4.2% in the 4th quarter of last year. Very strong performance. And a lot of that's been driven by light vehicle sales. As this chart shows you, consumers had been deferring purchases of consumer durables, autos, and the age of the fleet had reached a record age at that point. So that pent-up demand is starting to be satisfied. We've also seen easing credit conditions, especially in the consumer credit market, and people are starting to use their charge cards again. I think we'll hear a bit more about that in a minute. Slide 30, though. The housing market on slide 30. We continue to be disappointed by the housing market. Maybe we shouldn't be. There's a lot of challenges in that market. We're going to discuss those. The multifamily market has done much better. It's about back up to pre-crisis levels, but you can see that the single-family market just has not returned to where it was. So this is kind of the missing ingredient, if you will, of the recovery. Slide 26, please. This looks at non-defense capital goods orders. And as the slide demonstrates, there was some strength in the second half of 2014, growing almost a year-over-year rate of 10%. The last few months have fallen back. Some of that's because of the collapse in oil prices and the subsequent decline in oil drilling activity. But business confidence appears to be remaining strong. The question is, will capital goods orders remain strong? Slide 22, I'm going to talk just a bit about this. The value of the dollar. This presents a problem for exporters in the United States and firms that have operations overseas that repatriate the earnings back to the United States. And it's probably harming capital investment at this point. And the last chart, which we'll discuss as well, is slide 51. So the Fed ended QE3 last fall, but when will it finally begin to end its extraordinary monetary policy and begin to raise interest rates? The latest betting in futures markets is that it won't happen until December. So we'll see if the panelists agree with that. As they've said, it's somewhat data dependent. Let's get our panelists into this conversation. I'm going to introduce them in alphabetical order. Their biographies are in the full program. To my immediate right, your left, John Donhockle is managing partner of Leonard Green and Partners. Next to him is William Kahana, or Bill, who is co-founder of AR Capital. To my left, to your right, is Sarah Quinlan, who is Senior Vice President of Market Insights, MasterCard Advisors. And last and not least, to the farthest left, although that would never be the case, he's to your right, I believe, Gene Sperling, President of Sperling Economic Strategies, and former National Economic Advisor to Presidents Obama and Clinton. And we're going to put a bet on whether or not he might have some role in a future Clinton administration. I don't know what the over-under is on that, but we'll find out. What I'd like to do is start the discussion on labor markets and then get into consumers, because it'll have a lot to do with the timing of when the Fed first moves to raise interest rates. And it go a long way towards whether or not the U.S. can be a catalyst for the world economy, in my opinion. So let's start here. What I'd like to do is, Gene, you've worked in Washington, you have an immense amount of knowledge. Some might call it inside the beltway knowledge. We would never call it insider information, though. But just to understand, what Janet Yellen and how the Fed sees labor markets and how they're thinking about this. And we've seen the unemployment rate come down to 5.5%. But other labor market indicators depict more slack than that. Can you help us get inside Yellen's head and just what she's thinking about the situation in labor markets?
Yeah, sure. I always tell people if they wanted to read one thing that I think helps get a view into how Janet thinks or the chairwoman thinks. And obviously, I have somewhat of the advantage of that when I was National Economic Advisor under Clinton. For 3 years, she was the chairman of the Council of Economic Advisors. So I don't know what she thinks on a day-by-day basis. Right now in the Fed, I maybe know a little bit about her heart and her worldview. And I think you see that a bit in her Jackson Hole speech in August of 2014. And what she really says there is she makes pretty clear that she's not just looking at the headline numbers. As you said, she's looking at the numbers beneath the numbers because she is greatly recognizing that she's in a rather unprecedented situation, that nobody since the Great Depression has had to deal with a labor market that's so deeply scarred. And so she is not just looking at the headline numbers, and she's not just looking at the rate of improvement, she's actually looking how good things are. I was a Detroit Lions fan. We were 0-16 one year. We got to be 8-8 a couple of years later. Now, that's dramatic improvement, but 8-8 is still not that good. And there's a little bit of that going on in the analysis. So what she says in Jackson Hole is, you've got to look deeper. And we at the Fed have to ask a question. Is what we're seeing structural, in which case we, the Fed, can probably do very little? Or does it still have a cyclical element, in which case monetary stimulus could still help? And she says that she bets that a good amount is cyclical. And what you've seen since then is probably a lot of validation on her side of that view, because every indicator they're looking at underneath there, long-term unemployment, involuntary part-time unemployment, U6, which is the broadest measure of underemployment, all of those have gotten dramatically better. There's nothing that's not getting significantly better. But it doesn't mean it's particularly strong. So one thing I did, just as examples, I just looked at 2 other times you had 5.5% unemployment, which would be February '96 and October 2004. And if you look at those cases, you have 5.5% unemployment, but then you go to how many people are involuntary part-time, and you'll find it's around 4.5 million, where now it just recently dipped a bit below 7 million, having been almost around 8.5 million for 4 to 5 years in a row, the level of scarring. Long-term unemployment has gone down significantly, but if you'd like a depressing fact, the average length of unemployment is still about 30 months, or about, 30 weeks, or like 7.5 months. When the highest it had ever been in 55 years before that was 21 weeks. So 6 years after recovery, it's only down to 30 weeks, and it had never been higher than 21 weeks in our history. So I think what they're looking is they're seeing this getting better and better. And I think as they're coming into January, they're going, boy, if we keep having these gangbuster numbers, you know, even though we're looking at the pain beneath, we're worried about long-term unemployment, if we keep having these terrific job numbers, we may have to get off the dime. And I think you see them have a slightly hawkish tone, because I think they're saying, if we keep having 300,000 a month and everything keeps improving, we're going to start to hit that level where it looks less cyclical and more structural. And I think that's where they were going and headed. And now I think that they've had a whole lot of doubt. And I think the doubt comes from not just the weak March numbers, but you know, inexplicable consumer numbers like...
No. I absolutely disagree with you, all right?
Well,
I mean, in the sense that I think what is going on here is that there is actually a small black economy in the United States for the first time, because the reality is we see such strength in real consumer spending, and one of the benefits of who we are at MasterCard is we actually see the transactions. And the key thing to understand is that people are spending small. And so the fact is that's probably not getting picked up in the employment there. And I'm just thinking that maybe people aren't declaring that they're employed.
Well, let me just say, what I was saying is why I think they're seeing doubt. And I think they've seen doubt in the dollar. I think the impacts of the dollar have been much more significant and unpredictable almost at any time. And we can come back on that. But I do think that for them, and believe it or not, I'm with you. When I look, even though we had disappointing consumer confidence numbers today, when I look at jobs, when you look at wages, consumer confidence, there's a disconnect between what you're seeing in retail sales and the rise in private savings. I still think that would resolve itself in a stronger consumer spending. But all I'm saying is that I think there's a significant bit of doubt. And and to come back to your initial question, I do think Janet Yellen fundamentally believes in the hysteresis view that when you're unemployed for a long time, that the harm to that person and the economy is much, much deeper than short-term unemployment. And I think that when she's looking at her mission as the Federal Reserve, she's looking at the involuntary part-time, she's looking at the U6, she's looking at the people who just dropped out. And I think this is where heart and head come together. I think she thinks as long as that's not so good, that there is still more slack, particularly when you have involuntary part-time workers. I think she believes that workers can still be lured back in. But I think she's also going to be practical. But I think that but anybody who's just looking at the headline numbers, I would say, be looking at long-term unemployment, look at U6, look at involuntary part-time, because there's no question that that's what they're looking at to judge the true health of the labor market.
Well, Sarah, you already jumped in on it, but I mean, you've got your own real dashboard. Maybe your dashboard is one that Yellen should look at occasionally. So give us a sense of just what your dashboard's showing you and what's going on in consumer markets.
Sure. Just so everyone understands our methodology, we see 160 million transactions an hour. And with that, we then apply 1.5 million rules and algorithms to bring it up to total retail spend, including cash and check. And each month when the Commerce Department comes out with their statistics, they actually revise to us. We correlate almost 100%. So we're very confident because why? We get the smallest to the largest. So if you pull up slide 63, this is the most important thing that's going on in the United States right now. It's a 33.5% drop in gasoline prices, but we actually see consumption actually down 3.6% as well. So from that perspective, we know that there's money in the consumer's pocket. So the next slide I want to pull up is 64. So this is the economy. This is 70% of GDP. This is total retail sales. And you'll say, wow, that's a lot of volatility. That's pretty amazing. But remember, gasoline spending is 12% of total retail sales. So if you go to the next chart, it's a much more representative economy, which is 65. That's what it looks like if you take out gasoline. That is not a recession. That is not anything but the consumer continually focused and spending. And that's why it's such a critical thing to understand. This is what's driving the economy. And it's interesting because, for example, when I look at commercial cards as opposed to consumer cards, we don't see the same confidence. You know, I always joke about T&E. Well, first of all, there's no E post the recession. All right, that's gone. But actually, businesses aren't the ones who are traveling on those airplanes. It's actually the consumer who's traveling. So if you actually look at slide 67, this is where the spending is. Nope, 67 should be small business growth. That's not what my 67 is. That's it. Okay, these are businesses with 50 million of revenues or less per year. This is running between 3 and 5% each month ahead of the total retail sales number. That's why it's not getting captured in the data. That's why people aren't seeing it. If you're doing a survey, for example, the government surveys 50,000 retailers to do their monthly. I get everybody, smallest to the largest. So the difference is you can see the consumer prefers this unique way of spending. But the other reason that we're not sort of thinking about this being sort of as normal is the most important thing that we're doing post the recession is we are spending on experiences. So if we look at something, for example, like airline sales, I'm looking for the number, 76, please. You can see, we're flying all the time. I was joking that no one has their kids in school anymore. We literally travel all the time in holidays. So look at the next slide, which is, of course, lodging. So if you go to 77, it's even stronger. So this captures the people who are driving on their vacation in addition to those who are flying. And by the way, only 27% of Americans have a passport. They're not leaving the island. So their spending is staying here. And that's the reason why we're optimistic and we're understanding. And I think that Janet Yellen is going to have a more difficult time because, yes, you can look at the labor, but the fact is that we know post the recession, people don't spend if they have a job. We've watched people become what we call transactors in the card industry, and that means they pay off every month. And only in 2014 did we start to see people carrying small balances. So that just gives you a small sort of snapshot to start the economy.
Sarah, I've been accused of being an eternal optimist, but you make me look like a pessimist.
I want you to know my nickname on Wall Street was Duchess of Doom, too. So
Okay.
if I'm this optimistic, this is a big thing.
Okay, Gene, I'm going to go back to you real quick.
I'll just ask a question. So first of all, I think that's very helpful because it is hard to see the discrepancy, why are jobs, consumer confidence up and spending down. And so this is somewhat of an explanation. If you're telling me that the small business stuff just doesn't get picked up in the accounting, but how do you explain the fact that the private savings rate, which had gone down steadily to 4.4% by November, has now gone up each month to 5.8%? That is so inconsistent. I mean, does your data explain something that does seem inexplicable, which is why since November you've had this steady, unexplainable rise in the personal savings rates from 4.4% to 5.8% in just 3 or 4 months?
It actually doesn't. And because the interesting thing is if you look back and you can actually see, if we take out gasoline spending, in January, we were up 4.9% year on year in retail sales. And then in February, we're at 4.7, and then at 4.8 for March. So it doesn't explain it because we're not seeing that savings. We're seeing people consistently spending. And that's the difference of what I think is so interesting. The key thing is we just don't want stuff post the recession. So, for example, we see extremely weak department store sales. We see apparel, some months doing well, some months not doing well. So it's a very different economy in terms of what the consumer, for one thing, for example, no one buys teen apparel anymore. Why? Well, we don't.
My daughter does.
You know what? Exception. But what I will tell you is the reality, and sucker, all right? Because the reality but the thing is that you look at is we see, for example, people don't pay $300 for a pair of jeans for their teenager that outgrows them in 2 months. They're shopping,
That's
but they're
my
shopping
wife.
differently.
That's what my wife tells
There we
my
go.
daughter.
See?
When she really wants something, she
I know
wants
you need to get on to other two, but just for the record on, just since we started talking about Yellen, Yellen isn't really disagreeing with this. She is still predicting consumer spending. So the Fed is not negative. If they're concerned, it is probably more international, the dollar impact on export and manufacturing, and just wanting to see a little more certainty that the underpinnings of the scarring of the Great Recession and the labor market are receding.
If I could just show one more slide before we
One
move
more
on.
for now, and then we're
68, please.
Right.
This is the spending regionally, all right? And this is for the month of March. And I want you to ignore the Midwest, which is red, and ignore Washington, which is red, because that is an anomaly. That's the 1 month that they have been negative year on year. What I am concerned about is the Northeast has been negative for 6 months in a row. And there's two impacts of that. That is the fact that Wall Street didn't bonus last year, and if people don't have money, they don't spend. That's number one. And number two, that's the effect of the strong dollar, because the cross-border spend is dropping. And we see that, obviously, in the Southeast, and we see that in the Northeast most predominantly.
Bill, let me get you into the conversation.
It won't be easy.
It's hard. Yeah. You can't be shy on this panel. That's always been the case.
I am not shy, I promise.
Even Barry's not here. None of us have been able to speak.
Barry's not here, Sam's not here, but we still have a room full.
That's right.
You did a good
So give us a sense of what you're seeing in real estate markets in terms of what that might mean for the broader economy.
Okay, first a couple of disclosures. My wife's in the audience. Many of my colleagues are in the audience, which requires me to tell the truth, but first about myself and then about my business. So truth about myself, Econ 101, I got a C+. So consider the source of what I'm about to say.
That means you're probably right more times than we are.
Maybe so. But I was always told if you laid 1,000 economists end to end, they'd never reach a conclusion. As far as the business
Except
is
for
concerned,
Larry Summers.
I have nowhere near as much data as Sarah, but at the same time, we manage about $18 billion worth of assets, primarily bricks and mortar, but also financial instruments, oil and gas. And we acquire somewhere in the neighborhood of $500 million to $1 billion a month of assets. So much of what I'm going to suggest to you is not only based on the broad data that Green Street provides, but our own analytics. The good news from a real estate standpoint, and it's neither a leading indicator nor a trailing indicator, I think it just simply reflects the economy as it sits, is that real estate represents a very attractive asset class for 2015 in our view. It's fully and fairly valued. Its recent returns have been driven not so much by earnings growth, although that's beginning to kick in, but by cap rate compression or multiple expansion. Fundamentals in our business have rebounded to the point where we're seeing low vacancy rates, higher absorption, and low interest rates have been supportive to all that's gone on in the industry. Most of the sectors, and you have to kind of compare the food groups one at a time, but most are expanding. You see good improvement based on an improving economy in industrials, office, lodging, as you saw from the data that was just recently shown. Probably the greatest improvement is in the apartment sector for two reasons. That it's benefiting from some job growth and a real change in the decision calculus among the millennials who are avoiding home ownership. There are actually few oversupply risks going into 2015, except perhaps, and Tom would hate to hear me say this, but perhaps in senior housing. Healthcare, however, is and will remain, we believe, the fastest growing juggernaut based on demographics. The fact of the matter is that we're seeing repeated opportunities in medical office, hospitals, skilled nursing, and assisted living. Office markets vary from one to the next. Austin, strong, sitting cheek to jowl with Houston, based more on an oil economy, which is clearly challenged. West Coast, San Francisco, New York, Boston, strong entry markets in the US. Industrial supply, logistics, you would expect to be increasing with the improvements in the economy. Hotels remain constrained supply. They're benefiting, obviously, from an improving economy where both commercial as well as disproportionately private users of hotel rooms are taking up that limited supply with greater demand. We see more opportunity currently in select service than we do in full service properties. But the fact of the matter is, it's really all ships in a rising tide. Retail has tended to be a bit overbuilt on the one hand, but still kind of the bread and butter retail real estate, grocery anchored shopping, and to a certain extent, but a lesser extent, high-end malls will both benefit categorically from the uptick in the economy. So kind of overall, conditions remain in place for robust economic performance in the real estate sector in 2015. And if it sounds like I'm talking my book, I am. Markedly lower energy prices, tame inflation, reduced fiscal drag, strengthened balance sheets, particularly among tenants, and an improving real estate market overall should support the recovery.
Well, that's pretty optimistic as well. John, give us something not to be quite so optimistic about. So let's talk about inflation and consumer prices. So there are very few signs apparently that inflation is building, but you have some less conventional ways of looking at inflation that's just not trying to measure the cost of goods and services, that maybe brings in asset prices.
Okay.
So let's just take a look at what's happening there.
So let's put up page 55, and I'll sort of start this off by, first of all, the instructions were 3 minutes for opening comments, and we're right now halfway through our presentation. So I will try to be brief. But you know, I think Gene sort of said it all, and I'm happy to hear that the Fed understands that headline numbers are not necessarily the whole story. You've all heard it was Benjamin Disraeli said, "There's lies, there's damn lies in statistics." And then there's another saying that's sort of like it. It says there's liars, damn liars, and there's experts. So I will be your statistical expert up here and do what I can. But look, I'm sort of the least qualified to talk on issues of the economy up here. What we do, though, is we try to just challenge conventional wisdom. So there isn't a slide up here where you would talk about year-over-year trends, where I might say, you know what, it's not really about this year, it's about last year. And when you start looking at percentage increases in particular, it can basically create a very skewed picture. Now, I believe that the Fed understands that, but to the degree that things like an inflation rate or an employment rate starts controlling the national dialogue, okay, we're down to 5.5%, we're there, and yet we have underemployment, severe underemployment still in this country because participation in the labor force. What I would say is that first set of statistics is lying to you. Now, Ross, the question you asked about was inflation. And this is something that we came up with, but basically what we think is that traditional measures of inflation, they consider the national income statement, the goods and services, but they ignore the national balance sheet, and we think that's wrong. And I point on this slide particularly to 2008. And what you see is in 2008, measured inflation was 1.9%. Okay, that was a year where the national net worth declined $10 trillion, where real estate, your conventional housing, declined 20 or 30%. So does anybody really believe that in 2008 there was inflation? I certainly don't. So what we came up with, and we sort of talked about before, is a measure, and when real economists look at this, they laugh at me. But basically what we've said, we've got an income statement, we've got a $17 trillion or $18 trillion GDP, but we've also got now a $90 trillion balance sheet, $90 trillion balance sheet in the U.S. So we've sort of said, let's look at blended inflation. 20% will factor traditional, 80% will look at the change in the value of real and financial assets. And what you sort of see here is a really interesting story of the last, decade. In particular, 2003, 2004, 2005, 2006, where you had measured inflation in the 2 to 3% range, and you had the Fed pouring the gas on the fire with very, very low interest rates, but you saw this blended inflation rate flashing red, in the high single digits. Then what we had in sort of the 2007, 2008, we have, go ahead.
They lost your slide.
Slide. 2007, 2008, we have high measured inflation, but I would say blended inflation or real inflation was negative. And you saw that the Fed was slow to react, but then basically in 2009 reacted appropriately for a world or for a U.S. where the value of long-term assets were in free fall. So since then, we've sort of seen a recovery, and inflation, as measured today, looks moderate. What we see is, on a blended basis, this kind of weird way we have looking at things, it's actually showing some fairly substantial growth, and that's reflected in what's going on in stock markets and the real estate markets. And the Fed policies remain easy money. And so just something to think about. What does that mean? At the end of the day, if we end up back in 2003, 2004, 2005, one might be concerned that we would end up with 2007, 2008 again.
Good point. I mean, I'm sure there are members of the Fed. I know one that just left the Fed, former president of the Dallas Fed, that would have, he looks at similar data.
Yeah.
So he's an economist as well, so they do look at that. Let's just spend just a little bit more time on the consumer sector, and I want to because, you know, I get calls from the media, and the question is, what happened to the consumer? Why are they saving all the discretionary income from lower gasoline prices?
But they're not.
So what else are they spending it on? What can you show me that says they are spending it?
I think the most interesting thing that we do is we don't cook anymore. Now, we have an excuse for those of us in New York City because we have no space, so we actually use our oven to put our boots in. But, you know, the rest of the world doesn't have it. And so when we look at, like, slide 78, you will
78.
78, please. That's what we're spending on. So the last 4 months, we have seen restaurant be the leading indicator and the leading growth rate of over 7%. All right, so the key thing is we're dining out like there's no tomorrow. And I think that that's a big thing. This is the whole experiential economy that I'm talking about, where at a continual basis, we have seen 25 months in a row of jewelry increases, all right? Now, I think jewelry is not discretionary, personally, but the reality is it technically...
You'd like my daughter.
I know. It technically does fall in the discretionary category. The average price that people are spending on jewelry is $2,400. So the key thing, this is not custom jewelry. This is to understand that there is the consumers out there. Why? Jewelry is permanent. It's something that's unique. You can design it. 83.4% of that jewelry is sold in independent jewelers. You did not get a deal, by the way. But the point is that people are actually on a continual basis going out and spending in this way in the economy. And this is what we see. So for example, I showed you the airline before. The interesting thing is people purchase that ticket 2 months in advance. That shows you enormous consumer confidence because you're saying that 2 months later I can pay. And we know when someone takes a flying vacation, they spend double what they spend on a driving vacation. So that particular sort of spending that we're seeing consistently in the economy is the way. And the other thing that's very interesting and just sort of a misnomer that a lot of people, everyone thinks that everyone's spending online. And in fact, if you actually look at the online spending, we don't see that, all right? And interestingly enough, online spending is still 6.7% of total retail sales. That's it, all right? And I'm looking for my numbers here. These charts always confuse me. Hold on. We're looking for 92, please. And
See, Sarah, that was supposed to be the big reveal. You know, you're supposed to ask the question. How do you make, everybody that I talk with thinks it's 15 to 20%.
I know. This is the interesting thing.
7%.
But this is, again, really important to understand that the most important thing that you see in this chart is the last 5 months, we've dropped below double digit in terms of the growth. Now, yes, the base is getting a little bit bigger all the time, but basically it was winter. So we should actually see an increase during winter of online. Why is this? Because shopping is social. We really post the recession like our family and friends again. And that's the cool thing to understand is we are actually socially going out. So that's why what malls are doing the best? Those where we actually go dine first and then we go shopping.
Okay, and if I could just be I want to be the statistics police. Put that back up. Okay, look 1 year earlier. The reason why it's low is because 1 year earlier it was quite high.
It was quite high, but the reality was, if you look at, the interesting thing was, last year in January, February, March, we saw, the only place where we saw the growth actually was online because, remember, we were frozen. This year, the consumer just went and spent anyway. That's the difference of a year of
Opposed to this wonderful year of weather in the Northeast?
I'm telling you, the interesting thing was we didn't see the same drop in bricks and mortar in the Northeast that we saw last year.
Yeah.
And that's really a reflection of the improvement of the economy, because last year it truly was. We looked at the SMILE, which is California down to Texas, over to Florida and up to South Carolina. Last year, January through March, that's where we saw the only consumer spending, and everything else was red, like the regional chart I showed you before. This year, the only red we've seen was in March and in the Northeast, but the rest of the country actually was growing year over year, so it's a big difference.
John, you see anything else in e-commerce sales, I mean, the internet?
No, I do think it's really interesting to examine the internet and the impact that the internet is having. And you answered a question I was going to ask, which is how big is the internet? And what we find is it's actually quite small. It's growing. Retail sales today are growing about 4% a year. About 1% of that growth is on the internet, and about 3% of that growth is through conventional retail.
That's correct.
So the dollars going through conventional retail are growing faster than the dollars going online. But there's certain categories that get clobbered online, and they tend to be large, infrequent purchases, and they tend to be purchases of from very SKU-intensive businesses. So, for example, if you go into a clothing store, there's a good chance that you might find something you want, but not in the size that you want. And the great thing about the internet is it has infinite size, so they're always in stock. The impact that it's had on retail, and we get reports, we don't get anywhere near Sarah's, the richness of Sarah's data, but we get 20 same-store sales figures a year from our investments. The interesting thing about what's, first of all, a couple things. First of all, on services, completely agree. Our restaurant-related businesses are doing spectacularly. Beyond that, our services-related businesses are doing fabulously. We own the largest chain of car washes in the country. Their same-store sales are off the charts good. So on services, the same. Look, in traditional retailing, the role of a retailer is changing. And this has been what's been the most problematic aspect of the internet. The role used to be, you go into the retailer with an objective. The retailer would have stuff in stock. They would give you service. They would they would show you what's good, better, best. They would tell you what you might expect to pay for it, and they would charge you tuition for that. And the problem is today that knowledge is not as valuable as it used to be. Tuition is not. You can't charge as much for tuition because you have a more informed consumer. And you particularly see it for companies like Best Buy. If you want to buy a TV set, you don't go in and ask the salesman, hey, which TV should I get? What you do is you research it online, you come in, here's kind of the size I'm interested in, here's sort of the price range I'm interested in, and by the way, you're checking the prices because it's a $500 or $600 or $700 item, and 5% makes a difference. So those guys are the guys at sort of the front lines of these wars. But conventional retailing, so the impact on conventional retailing is really more what it's doing to gross profits, particularly in those SKU intensive and in those large infrequent purchase areas. We'll call that apparel, and we'll call that consumer durables. That's where you're getting impacted. Services, nothing.
Bill, want to jump in?
Let me jump in just for a moment. To validate some of what's been said, and then to ask a question that might suggest we're looking at this data, but only in the rearview mirror. We have large portfolios of lifestyle centers, power centers, as well as grocery anchored. And we are certainly seeing in the bricks and mortar, kind of on a gross sales basis, same store over last year, about a 2 to 3% sales pickup. So this comes as no surprise, pretty much supportive of the data.
Same number we're seeing.
But let me ask you this. I have a 14-year-old son, and he will investigate on the internet a particular piece of electronic. We will then visit Best Buy, and then he will go home and order it for delivery the next day. How much of this data is just, as I say, suggestive of our buying patterns and not the next generations?
No, interestingly enough, actually, when we have broken out the data demographically, millennials shop no different than baby boomers do. It's absolutely the truth. The interesting thing is, you're talking, both of you, in terms of what we call commodity products. You know, a TV is a TV is a TV in the sense that you understand the features. So it should be no surprise to anybody that 50% of electronics are done online, right? So that makes total sense, right? But when you look at other things like furniture, we don't have that same numbers.
Right.
Sporting goods, you know, apparel, only 23% of apparel is being done online. So the interesting thing is that you sort of see why. Well, it's more unique. 17% of jewelry. So again, as you get into more unique pieces, less of it's done online, and people want that. Now, you're absolutely correct. That's the whole point of omnichannel. People's websites are to educate the consumer of what's available, and necessarily then they come into the store and actually purchase. And the consumer is in charge here. That's the key change post the recession. They're making the decision of how they want to purchase, when they want to purchase, where they want to purchase. And we, in the business, must respond to that. And that's the key thing. We're not in charge anymore, and that's the difference.
Yeah. And the one last observation, and that is in our lifestyle centers, which are based more on food and entertainment, rather than the traditional notion of mall anchored by 2 or 3 department stores, the pickup is twice what I suggested. It's about 6%.
Exactly.
People are eating out, they are watching films, and they are socializing, which you can't truly do on the internet.
And by the way, our health clubs are doing quite well too. Same thing.
So
Well-
can I just throw one slide up there just to show the difference of why you want
You just
a
want
different...
to, you just want to brag and show how many slides
No,
we
I
have.
just think it's interesting. I'm a geek. So 95, and then I'll shut up. This shows you that not all lead stores are equal, right? So exactly what we're talking about, the lifestyle. The yellow line is the bricks and mortar for department stores, which is negative, right? And it has been for over a year. And the top is the online. And you can see the online's going down. Now, they had it early, of course, as you know, Easter was moved, 10 days earlier this year, so 15 days earlier, excuse me. So you can see sort of the benefit of the year over year there. But this is an area where this is not your lead. This is not what pulls people into stores anymore and into malls. They are coming in for your lifestyle malls. All right, I'm done.
Very good. Let's move into housing now. Not quite as optimistic as I've heard on consumption, but if you could put up slide 29. I mean, the housing market clearly has improved. It's been a choppy recovery. We're seeing existing home sales and new home sales have accelerated. And household formation rates seem to be coming back, but a lot of young adults still haven't moved out of their parents' homes. Some are moving into apartments now with about 3 or 4 people and what should be probably 2 people residing there. But we haven't seen much benefit thus far from low mortgage rates, it appears, despite very strong job growth. We've seen better income growth. So give me a sense of what's the view on housing. Is it the mortgage market? Is it so difficult to get a mortgage that that's the principal cause of it?
So obviously, we have people who are experts in large parts of the real estate market, but let me just give you my perspective on residential housing. I think one of the reasons that I'm not quite, I'm maybe a little more in the Rogoff camp than my friend Larry Summers' camp on some of the secular stagnation is that I do think, I can't tell you what half it happens in, whether it's the second half of 2015 or 2016, but I do expect home building and residential housing to be adding more to GDP than it is now. And I'll give you kind of one statistic, which is, the head of the FHFA, Mel Watt, was kind of giving a speech the other day, and he was explaining what the rate of serious delinquency was in Fannie Mae's book. And he said, well, it's around 2.5% of mortgages are in serious delinquency. But he said, now let's look at the composition. And he said, well, really, it was very high, over 8% for the loans originated during the buildup. But he said, but since like 2010 or 2011, it's just like 22 basis points. And it historically, before the crisis, was 3%. So 1/15 the level, not of the crisis, 1/15 of the level before you'd entered into the buildup, all the goofy, lack of underwriting. Well, my point is, anybody who ever played basketball knows you don't say to your coach, I've never had a foul in the last 4 games, because if you never foul, you're not playing tough defense. If you're having 1/15 of the serious delinquencies you've had in normal times, you're not giving out enough mortgages. Mm-hmm. The Urban Institute basically said, they did a very simple calculation. They said, how many more people would have homes, would be homeowners right now, had they just had the normal underwriting, the normal FICO scores of kind of 2001 and below. And they found, it was hundreds of thousands of a year, it adds up to 4 million. Now then let's remember that you get a hell of a multiplier effect from a new house that you don't necessarily get from rental. And I just feel like this is my, I'm the Democrat who's going to have a little bit of an anti-regulatory sound to my voice now. But I just think that we have, it's normal in a financial crisis, historically, that you go from too little taking risk in account to over-risk aversion. And we're still in that in housing. And it happens, I think, partly because FHA and FHFA, they get so concerned in making sure that nobody gets a dime they shouldn't, that people already risk-averse put more overlays. They're worried about putback risk. They're worried that they'll make a small mistake and that if the loan goes under, they'll lose it. And I think that's been a problem. And I think, I think some of the enforcement was very well deserved. But I think—
Can I interrupt for a second, Gene?
Just one sec. Can I just finish? Which is just to say, I know I spoke a bit at the beginning, but then I went a good 30, 40 minutes without. So, so that's just to say that as I think you get more certainty, more clarity from the regulators, I think you're going to see more other people, whether it's REITs, sharing economy types, coming in for those 700 FICO score families in a better economy who should be getting mortgages that are not. So I think these low rates are great if you have a really, really high FICO score. And we shouldn't go back to the age where we're not underwriting well. But there's a group of people in the 700 FICO score range that are being shut out right now, and as people have more certainty, have less underlays. In other words, they're being shut out even though Fannie and Freddie would still guarantee their mortgage. As that recovers, I think we're going to have greater gains, and I think whether Michael Milken supports that or not, I do think young people, as the economy improves, as you have less people coming out with a weak job market and high student debt, I think you will see more household formation. So when I look over the next few years, whether it's this 6 months or a year from now, I still see an additional 0.5% or more of growth to our economy happening as we normalize on residential housing.
John, I think I'm going to hear a bit of a different opinion from you. Am I right?
Well, I was just going to ask the question. Do you think that, that housing prices should be higher? And the second is, do you think that ownership of houses, that a higher percentage of the U.S. populace should own houses? Because we got up to close to 70% under the last regime. We're down to under 65% now. Do you think home ownership should be more? And do you think prices should be higher?
I don't have a view that we should have like a particular rate, like we should just, I mean, we've—
Yeah, but what you're proposing, though, is we want to build more houses. Okay, presumably if we're going to build them, somebody has to live in them. So the question is, should we have more people, a greater percentage of the people in this country living in houses? And should the housing, which has recovered its prices, should prices be higher?
Well, I think there'll be a supply response when you have more demand, so you'll have more home building, and that home building will be good. But I think what I would say is that I don't have like a target, but I think when you see a number of Americans who would like to get a mortgage at these very low prices, who can't do it because there's an overlay on their FICO scores. There's an overlay. They're getting judged at a tougher measure when the economy's improving. I don't think that's a positive thing. So I don't want to, if you say you hit a certain target, it implies that you would just underwrite to meet that target.
No, I'm just saying, should it be more or less? Should the price be higher or lower? And basically,
I would say that probably, in many places, we should probably have somewhat higher home prices.
Okay.
There should be less, and there should be less pressure on rental prices for a lot of families who are dealing with higher rental prices. So I would like to see a world where there's more home building, and I'd like to see, I don't want to set a target, but I think that FICO, I think credit is too tight on residential mortgages.
We've done that a couple times. Let me throw a couple of slides up because I do have opinions on this. Could you throw up 60?
I'll get you next.
So housing, slide 60 should be.
That's 6.
That's not 60. There's 60. Okay. So housing's a long asset, and we have a rather unusual in terms of worldview on housing and the importance. So, for example, if you go to Canada, your mortgage is not tax deductible. We do things in terms of agency supporting, in terms of tax supporting home ownership. There's good things with home ownership, provide stable communities. There's bad things about higher home ownership. One being that it creates an inflexibility in the labor force. But this is, as long as we're talking about statistics, let's look at 125 years of housing. And this is Case-Shiller, which is essentially looking at it relative to inflation. And what you see, there's sort of there's three periods. Okay, at the end of World War I, there was a big drop. Okay, why was that? That was basically the Spanish flu. Spanish flu came through and wiped out about 5% of the populace. So demand down, supply the same, housing dropped, and it stayed that way all the way through World War II. At the end of World War II, folks came back, they wanted to start families, and by the way, nobody had been building homes. So there was an adjustment upwards very quickly, which stayed in place until 1995. And that's the interesting time when things have departed from trend. Could you move to page 2, slide number 61? Okay, this is the 50-year slide. And what you basically see is kind of housing was doing what it should have been doing up until 1997. It was kind of keeping up with inflation. That's what housing does. And then what happened was you had the internet bubble, which created this wealth effect. It was $5 trillion of wealth created. Housing started to come off. Then the bubble burst. The Fed reacted by lowering rates and keeping them down. And so what was a consumer to think? Gee, I don't really trust the stock market anymore. I've been making money in my house. Boom, let's put our money into real estate. The government agencies supported it, and the basic narrative for almost a decade was, you can't lose money on housing. It always goes up. We need 3% down. We got ninja loans, no income, no job, no assets. Here's a loan, buy a house.
Exactly.
And as a result, we ended up on this re-indexed rate at 80% over where it should have been. The bubble burst, housing dropped, it never got back to the line. And the reason it never got back to the line, because interest rates are so low, they provided a cushion. Now, since then, basically, because of Fed policies, notwithstanding the points that Gene made about lending protocols, housing's starting to recover. And folks are saying that's good. I'm not certain that it is good.
See, I agree. I absolutely agree on this one because this is the most interesting thing. We actually see people moving closer to where they work, all right? And how do I know this? I look at where their dry cleaning spending is, their grocery, things like that, and then I look at their lunch spending, all right? So you see that they're actually very in proximity. Why? Post the recession, you have 2 people in a family working. And so they are choosing not to be so far away. So this idea of living 2 hours away. So we've seen, for example, in Chicago, the West Loop, so being developed out, the South End of Boston, et cetera, and where people are choosing to remain in the city, even in, for example, New York City with ridiculously high prices, we see this. So I think the interesting thing for us that we see is we don't see a pickup in appliances. And if that's when you own a home, all right? And we've only recently seen a pickup in furniture in the last 4 months. Up until then, we didn't. And that is actually renters replacing their furniture. It's not people are buying. So I'm not convinced. I think we're going to be more like Switzerland, where I used to live, where only 40% people own the homes, and not the value add that going forward. I don't know, Bill?
Bill?
Could I have John's slide 60 back just for a moment? Yeah, as John pointed out earlier, aptly so, these first two incidents, if you will, were clearly driven by demand or lack of demand. In the first case, whether it have been disease or loss of life in World War I, clearly there was much lower demand during that period, and that had a direct effect on housing prices. We came out of World War II, the argument being that 5 years of really deferred buying and family creation gave rise to substantial demand during that period. This last piece is driven almost entirely by cheap money. And anyone out there who continues to think that their home is an investment needs to rethink that entirely. Your home is a consumable. And I would posit we don't invest in housing. We are derivative by funding certain home builders in markets. So to that extent, derivatively, we do. But I will suggest to you that home ownership in America, the notion of 40 acres and a mule on which this country is built, is absolutely passé. It's gone the way of the landline and the wristwatch.
Well, I'll give you another thought, all right? My daughter was working for a startup that was acquired by Twitter. 2 years, $100 million, she got rich.
Congratulations.
Yeah, really.
Mazel tov.
But the point that was interesting was 6 of the people were immediately told by Twitter they had to move to California. So they were not, and there was no reload package or any, you know, the thing, that's so 2006, right? So the point is that you sort of sit there and see this type of movement. So the young people think, why would I invest and put the majority of my net worth in something like that when I might have to move because I work for a global company, many of us do, and this opportunity where they say you go, you go. And I think that's the economy that people are living in, and I don't think it changes anytime soon, even if we start to get the job creation that
Well, I think we just heard that perhaps we shouldn't be quite as optimistic that housing's going to come back, maybe a little bit more, but we're not going to get back to 69% ownership rate, maybe 65, whatever the number is.
Ross, I think it really depends on Fed policies, and at every panel I've been, people have asked, what's the Fed going to do? But at the end of the day, if they keep interest rates at 0, that number is people are going to start extrapolating in a world that tends to like reversion to mean. So it'll continue to go up as long as interest rates are 0.
All right.
It's just very hard for me to hear a whole discussion on housing as if the whole thing is just on interest rate and consumers, and there wasn't any kind of complete breakdown in the underwriting process in the United States of America. Or so I think there's a lot of different policy reasons there, and I think the point is not hitting a particular rate. I tend to think.
No, gee, we're having a violent agreement.
Okay.
The breakdown in underwriting is what took it to 80%.
Right.
So violent agreement.
Okay. So look, I think the issue of like, do people still aspire to own a house is a little bit, it's going to be a little bit more probably gut feeling, and it'll be a little hard to tell. And I think, but I do think the issue is less that you hit a rate, or more that we should be, it doesn't upset me at all if your daughter's, co-workers don't want to do that. I do think there is a decent number of Americans who want to get a house today who are being shut out by over-risk aversion and regulatory uncertainty. And I think that's a problem. And I would like to see them, if they would like to buy a house, able to do so. And I'd like to see the multiplier effect that comes from that. And I think that is robbing our economy of of a chunk of GDP right now.
But don't you think the 20% down is a bigger issue? We're talking about the underwriting, but that's assuming they can come up with the 20% down. And with wages not being pushed and bonuses, you know, your bonus has been keeping your job for many people, right? So the question is where they're coming up. You know, it's fine if you're turning a home and you're selling one and buying another, but the question is where people are coming for that 20%.
There's still options for people to have less than that or pay a little mortgage insurance or have FHA. But I still think, you know, there's, again, a group of people, and I think for a lot of people, they don't look at it quite as an investment. They look at it as a choice of paying rent or taking that money that they're doing for rent and having some equity when they leave. And I still think a lot of middle America looks at that, and I don't think that's crazy, and I don't think that chart undermines the wisdom of that for somebody who wants to stay in their home for a while.
All right, so debate on housing, it's probably going to come back, maybe not to where we might have thought it was going to be based on kind of pre-2008 world. Let's spend just a moment on business investment. We've talked about consumption and housing, the biggest parts of the economy, and over the last year, it really looked like businesses were stepping up. If you look at slide 17, for example, shows you corporate profits. They've been at record levels, but yet we haven't seen firms reinvest in business investment. Why do you think that corporations, small businesses have not been willing to put up that commitment to invest in productive capacity? What's been missing? Is it starting to change?
We don't see it. And it's very interesting, you know, when I look at, as I was saying before, in corporate spending on people's corporate cards and things like that. And then I'll talk to, for example, our issuers and even see the uptake of the corporate cards and things like that. And then I compare, you know, I can actually in the consumer card see who's running a small business on their consumer card as opposed to running it on a corporate card. And you just see this reticence and just this not complete confidence. And that's why I'm saying it's at an anomaly with what we're actually seeing. The consumers actually got more confidence than actually businesses do. And you know, a lot of people throw regulation or whatever at it, but from the perspective, we just don't see the spending.
Mm-hmm. You know, I would agree. I think that CapEx has been the critical missing piece in this economic recovery, and in turn, the corporate profit cycle. As business confidence improves, CapEx should naturally accelerate, playing its role in both broadening and extending the current expansion. We need CapEx to sustain the profit cycle because one company's CapEx, is another company's kind of top line, right? So they are clearly interrelated. Corporate profitability, and we're sitting on trillions of dollars of profits currently, is good typically when margins are high and business is confident. We'll see investment in capital expenditures. And we are, from a margin standpoint, we're close to peak, at least. Business confidence seems to be returning to the system, at least as we see it through the bricks and mortar. And economic uncertainty, to a mild extent, has begun to fall off. There's lots of anecdotal evidence from the surveys that companies are more confident in their outlook, and they're showing a somewhat greater willingness to invest. The U.S. has been easing credit standards for the last couple of years, and this too should be supportive of spending on capital expenditures. Balance sheets are clearly more robust than they've been, and if you look at capacity utilization at 79%, it really is at a level that it was just pre-crash. So, you know, I would suggest that these are levels more consistent with accelerating business spend, and we should see it kick in the near term.
John, do you see anything different in the businesses you work with?
Our business services companies are doing great. We don't really invest in sort of heavy industry or manufacturing. You know, but look, this is sort of the tension between, you know, trickle-down economics. At the end of the day, business people invest if they see opportunities to make those investments, to get acceptable returns. By lowering interest rates, the Fed has made the cost of capital cheaper, so that would encourage investment. On the other side, you need to have demand to basically also encourage investment. And right now, we're sort of at this funny equilibrium. I have another slide. I think it's probably in the interest of time, I won't go there. But basically, if you look at sort of pre-crash, private sector borrowing was going up by about $2.5 trillion a year. Today, it's going up at about, it was going up at $1 billion, total borrowing was going up with about $1.7 trillion out of the private sector. Today, since the crash, it's been about $200 billion a year. So we've lost $1.5 trillion of demand coming from increased borrowings over the prior year coming out of the private sector. And that's why we have a sort of a tepid recovery, because we're not growing borrowing as fast as we used to. And by the way, that's a good thing, because we were on an unsustainable borrowing trend.
I would also argue just that the rest of the world economy, so if you're a global company, this is a bigger challenge. You know, I've got a couple slides just real quick. 98, if you can pull it up. That's Brazil, guys. So it's very, very, you can see that the B in the BRICS is not working really well. And obviously, the interesting thing is 63.2% of their economy and GDP is based upon consumer spending. And then the next one is 99, please.
Okay, but wait, keep it there for a second. Look at February, go back. Look at February.
Yeah.
Look at the year before.
No, but
okay, it was down off a huge peak.
Let me be really clear.
And that's what bothers me about year-over-year percentage trend charts.
No, I appreciate, but I want you to know that was also when the election occurred, and that was a vote directly, because right after the election, she raised fuel prices. All right, it's the only country in the world where the cost of fuel is going up. So that's the issue of what's going. And then the other response is just the change in date of Carnival, of why it rebounded. And then just the next one was just to show Hong Kong. And that obviously shows the huge drop in spending from mainland China coming into Hong Kong. So you could actually see that. Anyway.
Very good. Yep, go ahead, Gene, please.
I'd just raise one issue. You know, in the last few months, I've been attending some of the conferences that have been hosted by McKinsey and Larry Fink and Mark Wiseman at the Canadian Pension. And, you know, I mean, they're raising the issue very much about you know, the pressure on short-term quarterly capitalism versus long-term. And, you know, nothing definitive, but in this period right now where you have so much buybacks, you know, stock buybacks of your company, et cetera, I mean, you have to look at those numbers. And I have nothing definitive, but it is worth raising the question whether some of what we're seeing is people being over, you know, not feeling confident enough that they'll have the support they need if they're doing more long-term capital planning, investing, versus the pressure to do buybacks, dividends that will be more immediately pleasing to their investors. So it's just, I raise it just as an issue because I've been in other forums, many CEOs, where I think this issue is becoming more topical. And that's not a proof point of it, but it's an issue.
Real quick, let's focus on the dollar for just a minute, as it might be affecting the business's ability and willingness to invest. So slide 27 should show you exports and import growth. Now, the recent numbers in February are affected by the West Coast port strike, but still, clearly, export growth has slowed. And this doesn't even fully reflect the rising dollar that we've seen, up 15 to 20%, depending on how you want to measure it. So the question is, how much should we be worried about export markets slowing down and that feeding back on capital investment?
Well, just 2 points, which is next time I will bring my own charts. But if there's if somebody wanted to go look at something, look in the ISM on the new export orders. I mean, it's just gone down from 55 to 47.5%. Now, I would have been probably like a lot of people at the Fed saying that don't worry about a strong dollar. But, you know, you just can't ignore so much evidence. You look at the new orders index, you look at the new export orders index, it is down significantly. And remember one thing, we, the United States government, I'm not part of it anymore, but there's no question we're the growth cheerleaders of the world. We've pushed Japan, Europe to do the QE because fiscal policy has failed to stimulate, and so you have this issue where the central banks have become the saviors of last resort. But what your hope is that when they do their QE, it's going to have a currency effect, but you hope the demand effect will be great enough. In the absence of that demand effect, everybody's just competitively devaluing against us. So I think the real question is, there's no doubt we're becoming less competitive, our currency is, with the people who are doing QE, and that shows our dependency on the rest of the world. If that doesn't work on getting their demand, then we've just we're just watching everybody competitively devalue against us. And it's hard for me to believe that the Fed isn't slightly worried about that right now, of increasing that effect. And so I can't believe that's not going to be weighing pretty heavily on their minds tomorrow and in the months to come.
Anything else on the dollar? Concerns about it? Don't have businesses abroad? What about tourism?
It hurts luxury spending. I'll
Right.
tell you that much. That's where you see it the most. The majority of luxury spending in this country is done on the island of Manhattan, and it is very much affected by this and the cross-border. I like to sort of say it's really no longer chic to be chic, and we're sort of seeing this actually. We're seeing it's affected in London, and we see it in Miami, and we see it in Manhattan.
Theoretically, you would expect, particularly the tourist dollar spent here in hotels or some form of entertainment, would be deeply affected by the change in strength in the dollar. However, when you look at many of those trips, they're pre-booked for months in advance. So it mutes the effect somewhat of the stronger dollar.
Right.
As far as investing abroad, we put about $1 billion of money to work, dollar denominated, in Europe. Over the last 2 years, we've hedged our currency risk, and we've created a natural hedge by borrowing in that economy's currency, because what goes up can come down, and we don't want to get caught in that bind.
Let's do the elevator pitch round. So we've asked the question, can the U.S. be a catalyst for world growth? John, give me your elevator pitch. Where do you think we're at?
I worry about the U.S., its impact on the world. I don't have a great opinion. I would like to say one thing, though. At every meeting of this nature that we've had, everybody says, when is the Fed going to raise?
Yeah.
And the interesting thing, I think, if you look at the last few years, let's reverse it. Okay, the Fed cut first, and the European Central Bank basically didn't. How'd that work out for them? Not very well, right? Today, and this is a week or so old, we have Switzerland, Germany, Austria, France, Belgium, Netherlands, Finland, Denmark, and Sweden. They all have a 2-year bond with a negative yield. 2-year bond with a negative yield. Ours is +5. Now, do you think in that environment the U.S. is going to really raise rates appreciably? Maybe symbolically they'll do something, but appreciably?
I agree.
I don't see it, because when it was reversed, it sure didn't work for Europe. So the question is, what does that do? And I want to give one other example.
Okay.
Ireland today. They had 30 or 40% interest rates back in the middle of the crash. Today has a negative rate on their 2-year bond. Ireland. So is the U.S. going to do anything? I don't know, not much.
Bill, what do you think? Where are we at?
Unlikely to be a catalyst. We've got legacies both in financial and euro area crises, still visible in many countries. Varying degrees, we've got weak banks, higher levels of debt, public, corporate, private, still weighing on both spending and growth. We've got low growth in turn, which makes the whole deleveraging process slow. You've got to view it in the overall context of the emerging markets as well: lower capital accumulation, lower productivity growth, which combines significantly lower potential growth in the future. More subdued prospects lead in turn to lower spending and lower growth. So net, unlikely to be a catalyst for growth.
Sarah.
I'm going to be a little more optimistic. I really, truly think that I believe, for example, the jobs number will be revised from last month up, and I will continue to see. Now, will we be the catalyst for everywhere else? Well, there was only one other country that stimulated from the very beginning, and retail sales are doing amazing, which is the UK. Yeah. So, and I think that what's going to happen is we're going to see the other economies. We're starting to see a pickup in Germany. We're starting to see a pickup in a couple of others, Spain, in terms of the retail spending. So I think we just need a little bit more time here. The Fed won't move, all right? They're going to stay where they're staying. So, but I think what we've done by the fact that we've improved has started to lead other countries to start to slowly but surely make the changes they needed to make.
Gene, your 15-second conclusion.
I'm optimistic the consumer will come around. I think the data is a little more mixed than Sarah's saying, so I would be a little less unsure. The private savings rate going up still is conflicting and a little inexplicable to me, but I still go positive there. I stay positive that housing at some point in the next 12, 18 months will rebound and add more to GDP. I'm confident that, I feel fairly confident that China will not let themselves fall that much below 7%. So my biggest worry, I think Mario Draghi's doing everything he can, but I think Germany's got to get on board and start figuring out how to get their consumers or them to spend a little money, because I still think Europe is the biggest worry for me. So.
All right. Well, please join me in thanking our panel. I think we were cautiously optimistic, maybe. Very good. Thank you. Thank you very much.